Appreciate everyone coming out and spending a little time with us. Let's get started. So we are through Q1 and the spring is here and the market's starting to pick up. If you got any questions over the next 60 minutes, put it in the chat box. We'll monitor the chat box. There's no question that goes unanswered. So everybody knows who I am, Dave Flashner, the Regional Vice President of Stockton Mortgage. I've got my team and I wouldn't be who I am without them. With further ado, we got Beth Martell, who's not with us today. She is on maternity leave, baby number 2. So we're super stoked for her. We're excited for her return as well. We've got Suzette White. She's my loan partner. Say hi, Suzette.
Good morning.
Certain that every single person has dealt with Suzette in one conversation or another. She's the best. We also have Amber Jervis on the line. She's our branch marketing director. If you guys ever need anything from a marketing aspect, if you need something co-branded, if you want something, the slideshow, if you need anything recording, just reach out to us. Amber's, we'll put her email address in the chat box. Any questions, concerns, you can always ask her and we will get that back to you. So thanks for Amber. We love you too. You work hard and she's a big part of these presentations. I couldn't do it without her. So thank you. All right. So 2023 real estate, what's happened so far? Every single time we have a conversation about real estate, things change. We're constantly changing. And it's never been more than now. What we did last year is a little different than this year. What we did a couple months ago is now different. We're back in that spring market. So what does that mean? It means more houses are for sale, but it also means more buyers are looking at those houses. If you asked me 2 months ago, I said it's the perfect time to buy because you're on that deli counter getting that roast beef and you only have 3 people in line. Now you're on the deli counter and you might be 10 or 12. That spring market, weather's nice, the houses have more curb appeal, and you're going to get more buyers. So if people ask me when's the best time to buy, it's always now and not tomorrow. It's always now. If you asked me 2 months ago, that was the best time because there's less people shopping. Yeah, there's a little bit more houses on the market now because the weather's nicer in that spring market, but that opens up for a lot more buyers. So what has happened in the last couple months? The sales of existing homes is up. What does that mean? Looking back from February, we've got an uptick of the amount of homes on the market, exactly 14.5. So it's the first time in the last 12 months where we've seen an uptick in the amount of houses that are for sale. That's a good thing because there's really not much out there, but we have an uptick in the amount of houses that are being listed. These numbers are not just Georgia, these are across the United States. It is the biggest increase since 2020. That's a good thing. So for a while, we just didn't have enough houses for sale. We're still in that boat of not having enough houses for sale, but an uptick is a good sign for buyers because now there's more to look at. All right, so this number scares me a little bit, but it is what it is, that the values of houses just keep going up. The average median home sales price across the last 12 months is $363,000. Now, I say that scares you. We're also looking at California, Chicago, New York. That factors into that average. I know Georgia is not California and we're not New York. But if you look at the average median sales price across the US, it's $363,000. This number, it's 0.2% drop from February 2022. That means just we didn't have the increase in values over the last 12 months, but I do see that changing over the next 6 months because now we have more listings, then that creates more buyers and that creates the values to go up. But if you look at it the last 14 months, we did have a small drop in values. Again, that really means that we just didn't have enough buyers and then houses weren't increasing. I see that changing over the next 6 months. So where are we at as far as median sales price? The bulk of the houses for sale are between 250 and 500K. We're not, the houses under $100,000, they just there, they don't exist that much. If you see my fancy pie chart that Amber helped me make, the bulk of it, 45%, are between 250 and 500,000. Let's call that half. So the majority of the homes for sale are between 250 and 500K. Anything under that, 100 to 250,000 is 23%. I believe if we really dove deeper into that, you're going to see most of that 23% between 200 and 250. The houses on 100,000, 150, they're just not out there anymore. It's unfortunate, but that's just the way the market is. And I don't care what state you're in. Even if you find a house for 100 grand, it's probably not in good condition. Not saying they're not out there, but that's just the bulk of what we're looking at across the United States, not just in Georgia. Okay. So look at the trends that's happening right now. At one time, we said millennials are buying houses. Millennials are not buying houses. It's just, I guess that generation don't want to be stuck in one place. They want to travel more. The baby boomers are still buying houses. I say that for the real estate agents on this call. The bulk of the business is still being done by baby boomers, by Gen Xers, myself. We love real estate. The Gen Zers and the millennials, the majority of them, they're traveling. They don't want to be tied to the house. It's just a different mindset. Baby boomers are still the ones buying the real estate. They're repeat buying. They're always looking for that next purchase. 26% of the buyers are first-time home buyers, which is down, right? The first-time home buyers are scared from this market. I disagree. If you get me a first-time home buyer on the market, I will explain to them why owning real estate is still the best investment that money can buy. It will always appreciate over the long term, right? Over the long haul, buying a home, your net worth will go up. This is to all of my buyers on this call. The best investment money can buy is real estate. I do not care what environment we're in, what economy we're in. If you look at 2008, we had a really bad decrease in the value of a home. If you owned a home in between 2008 and 2009 and you just bought it, the value of the house decreased. If you look at that value today, it's probably went up 200%. There's no other investment that you can do that with. The greatest investment money can buy is real estate. So for this stat where it says 26% of buyers were first-time home buyers decreased, I hope to switch that. I hope to send the message out that first-time home buyers need to be up. We need to have more buyers in this market that are first-time home buyers. It will create wealth for the long term. Gen Zers now make up 4% of the home buyers. And now they're starting to buy more compared to 2000. Again, all these numbers will change in the spring because I think more people will buy. All right. I love this. Medical collections was always a thorn in my side and other people's side because they are reported on credit reports. I told you last year, if you follow me, as of 2022, they were reporting that if you paid a collection, it would automatically was removed from your credit report, which increases. Now, as of any debt that has $500 or less, paid or not, is not being reported to your credit reports. That is a huge thing for people with medical collections. I see it every day. We have people reporting $184, $318, their medical collections. They don't pay it because they don't think it's theirs, and it ruins their credit score. It really does. Now, as of March 30th, 2023, if it's $500 or less, they're not allowed to report it. That's huge. Okay. Combine that with any credit, any medical collection that is now paid in full, removed. So they're really starting to hum down on the credit reports and medical collections. With this approval, with this medical collections being removed, their expected mortgage approvals increasing by 5%. I love that. Buyers should not be penalized for having medical collections, and they're doing something about it. So love that law was passed. They're doing something different. Everybody knows that in mortgage world, we go on mortgage FICO 2, 4, and 5. They're releasing something called FICO 10. There's no release date, but it's also messing with the algorithms to get more people buying, to get more first-time home buyers approved. This, again, might be later on this year, might be next year, but FICO 10 will be released. I just don't know the release date. I will let you know. All right, let's get into the first-time home buyer seminar. I love this stuff. Who is considered a first-time home buyer? Does anybody know? Let's put it in a chat box. I give you the answer, but first-time home buyer is someone who has not owned property or on title for 3 years, okay? So if you owned a home 5 years ago and sold that home 3 years ago and 1 day, you are now a first-time home buyer. So you can be a first-time home buyer more than once. You can be it 5, 6, 7 times. So an individual has not held ownership or a principal residence for 3 years. That is the definition of a first-time home buyer. If we have a couple and one was a first-time home buyer and the other ones are not, okay, the file is your first-time home buyer. Both spouses are considered first-time home buyers. This is great. All right, so can you be a first-time home buyer more than once? Let's put it in the chat box. Anybody? Correct. You can be a first-time home buyer more than once. You can be a first-time home buyer 5, 6 times in your life. If my grandpa Norman, who is still alive, bought a house in 1972, sold it in 1985, he is now a first-time home buyer. So what does it mean to be a first-time home buyer? Unfortunately, not that much, guys. It's a term that we throw around in this industry very often, and it's overused. People come to me and say, hey, I'm a first-time home buyer. What does that get me? You get access to certain loan programs. Conventional loan, 3% down. If you're a Fannie Mae first-time home buyer, 3% down, you have access to that 3% down program. Other than that, there are certain grants, certain down payment assistance that you can get as a first-time home buyer. But other than that, there's really not much more to it, guys. There's no discount in interest rate. There's no special programs just for first-time home buyers. You get access to a little bit, but not much. So again, we use that term quite often. I love it when I hear that because I get to teach a little bit more. I go in depth, like I do conversations like this, but there's really not much access to programs for a first-time home buyer, okay? There are 4 programs for financing. Everybody knows conventional loans. We have FHA loans, USDA loans, and VA loans for our veterans. Let's dive a little deeper. A conventional loan, minimum down payment is 3%. Now, a conventional loan is considered Fannie Mae and Freddie Mac. Those are the ones who insure loans. They are not government run. They are not government backed. What does that mean? Fannie Mae and Freddie Mac makes the rules. They're like insurance companies. So we'd have to adhere to their rules. If someone defaults on a Fannie Mae or a Freddie Mac loan, Freddie and Fannie buy that loan from the servicer, and they now have that foreclosure, which they can sell back to the public. So they make the rules. They require at a minimum of 3% down. They are much stricter with their debt to income ratio. We will dive a little deeper into later in this conversation what debt to income means, okay? They have stricter minimum requirements for credit score and credit profiles, okay? A Fannie Mae or Freddie Mac loan can be used, which is, we'll call that conventional. They can use that for primary residence, second homes, and or investment properties. So if it's someone buying a second home or an investment property, they will be using a Fannie Mae or Freddie Mac loan, which is conventional, okay? An FHA loan, FHA, Federal Housing Authority. This is a government-backed loan. Same concept with who's the big brother and sister? FHA, which is the government backed this loan. If you defaulted on this loan, the government takes this loan back and sells that as a foreclosure. So they make the rules. They require a minimum of 3.5% down. They are way more lenient with your debt to income ratio and way more lenient with your scores. But a government loan must be used for primary residence only. You cannot use a government-backed loan for a second home or an investment property. It is for primary residence only. What is the definition of a primary residence? Where you're going to rest your head for 6 months more, 6 months and a day in the year. You also have to have employment or at least close to that home, right? Now, if you work remote, we can work around that. Let's say your company's based out of California and you're allowed to work remote. Then by all means, you can buy a primary residence in the state of Georgia, okay? Got to be explained. So primary residence is for government loans. VA loan, this is for our veterans only. If you served in the United States military, you have access to the veteran loan. In my opinion, it's the best loan out there. 0 down payment, no mortgage insurance, right? Where FHA, USDA have monthly mortgage insurance that is part of your payment. The VA loan, which is also a government-backed loan, primary residence only, it is no mortgage insurance, must be used for your primary residence. Here is the myth about VA loans. You can use your VA loan more than once. You can have more than one VA loan at the same time. It's about your entitlement and how much is tied up from that VA loan as part of your entitlement. Once it's capped out, then you require a down payment, but it's a percentage. We can have an off topic conversation about that. I can really get in depth what a VA loan is, what the details are. Now, I will say this to all my real estate agents on this call. There's nothing wrong with the VA appraisal. Okay. The VA appraisal is probably the best appraisal that you can order. Okay. Does it take a little longer? Yes. I can't rush a VA appraisal. They take about 7 to 10 business days. Okay. But the one thing great about a VA appraisal is if it doesn't come within value, the VA is going to give you as a real estate agent an opportunity to provide comps to show your value. It's called Tidewater. It is the only loan program that does this. If I order an FHA loan or a USDA loan or a conventional loan appraisal, and that doesn't feel like the appraisal will come in value, there's no opportunity for us to explain why we think the value is there. The report's just going to give as is with the value that they determine. But that VA appraisal is going to give you a 3-day period. And I'm going to come back to you as an agent and say, hey guys, the VA appraiser is initiating Tidewater. You want to sell this house for $250,000? Please provide me the comps that you feel where we're getting this $250,000 from. Then you have an opportunity to sell it to that appraiser where you're getting that value from. It's awesome that they give you an opportunity to give you a chance to find your findings. To me, it's the best appraisal out there. I love VA loans. We get a lot done. And if you knew, it is the least loan on defaults. It's at less than 5% default on loans on a VA loan. Okay. It is the number one loan for financing when it comes to default rate, right? It's very few. This helps with our values. There's very few foreclosures. So it's a myth in the real estate agent that the VA loan is bad. All right. Sharita, you asked the question on what loan programs don't allow them. Every one of them except the VA loan gives you an opportunity as a real estate agent to have Tidewater. All the other loan programs, that appraisal just gives us the value. Any other questions before I move on? All right, awesome. USDA loan, United States Department of Agriculture, another great program. I love this program because it's 100% financing. They're very strict on DTI and income qualifications. Those income qualifications is household income. If Mrs. Smith buys a house, Mr. Smith is not on the loan. Even though Mr. Smith is in that house, I have to look at their income. It is household income. If Mrs. Smith is buying a house and Mama is living with Mrs. Smith, I've got to look at Mama's income. Even if she's retired, even if all she collects is Social Security, I've got to look at Mama's Social Security because she's part of that household. Okay? So it's household income. So you must use this as a primary residence. Again, this is a United States Department of Agriculture. It's a federally backed loan. So primary residence only. All right. So a USDA loan is considered a rural loan. It has to be in a rural area. Okay. Not every zip code is allowed for rural. So if you're interested in a USDA loan, get with your agent, get with me. We can look up the address to tell you if it's in that zip code. You could look it up yourself. Google USDA eligibility. It is a super easy and super friendly app server. And you can look up the address to tell you if it is in an USDA eligible area. But you can always call me or your real estate agent. We can do that for you. One thing about the USDA loan, only loan program that can allow you to roll in your closing costs. Let's say you're buying a house for $200,000 and the appraisal comes in at $205,000. I can get you a loan for $205,000. No other loan program will allow that. Now, I don't promote this because we don't know what the value is until the appraisal comes back in. I call it gravy. We get extra gravy if that comes in, but don't assume that it will come back in. So if it does come back in, we can finance some of the closing cost. Now, that buyer still has to qualify for the extra, in this case, $5,000 that we just said. Sales price is $200,000. They qualify at $200,000. Value comes in at $205,000. Hey, Dave, can we roll in some closing costs? We got to make sure they qualify at $205,000 as well. Again, we don't know that until the appraisal comes in, but it's the only loan program that allows that. There is mortgage insurance on the USDA loans, not like VA loans where it's zero mortgage insurance. USDA, there is mortgage insurance that's on for life. It's 0.35. It's fairly cheap. It's part of your payment. Yeah, USDA loans, I love them. They're cheaper in price in some cases because the further you go away from the city, you're going to get more bang for your buck. But some people don't want to live further away from the city. Some people do. But yeah, great option for our buyers. All right. So when we're looking to qualify a buyer as a lending institution, what are we looking for? The three most important things that we are looking for is the credit score and credit history, your income versus debt, which is called your DTI, and your assets. Guys, this is not the only thing we're looking at, but these are the three most important things. There's a lot more to getting a buyer qualified, but these are the meat and potatoes of what we're looking at. And as you see, I labeled all three with check marks. One is not more important than the other. Okay, you can have a great credit score and a great credit history, but zero income, you're not getting a loan. You might have a great credit score. You might have 500,000 in the bank, but no income. Sorry, not getting a loan. Same thing. I've got 500,000 in the bank. I make 300 grand a year, but I've got a 480 credit score. Sorry, not getting a loan. One is not more important than the other. So we look at every one of these individually. Okay. When we're looking at income, when we're looking at debt, we break everything down to the month. Your monthly car payment, your monthly minimum obligations on your credit cards, any installment loan. That's what we're looking at. I don't care if you say, hey, my car payment's $475, but I send $600 a month. I don't care about $600. It's your monthly obligations. That's the same thing with your income. I break it down to a month. So we look at your monthly income versus your monthly debt, and that is called DTI, your monthly debt to income ratio. Okay. We just went over that, which is the most important qualifying factor. They're all important. None of these factors weigh more than the other. They're all equally as important. Okay. So these are credit score minimums. Those FHA deals, 580. You can go lower than 580, actually. The minimum is 580, but FHA doesn't have an actual minimum requirement. Most lenders want you at 580. We are direct servicers for FHA. So what does that mean? As long as we have an approve eligible in our automated system, I'm not going to get too geeky with you, but we run every single file through an automated system. That's our pre-underwriting findings. If I get an approval below 580 and you put down 10%, we got a good deal. So 580 is that minimum, but if you have a 530 credit score and you put 10% down and I get that automated approval, we have a good loan. Okay, but we do strive for that 580. That's our goal. Conventional 640, VA 580, USDA 620. Those are all the minimum credit scores. Okay, and again, just because you have a 580 on an FHA loan doesn't mean you're qualified to buy a house. There's a lot more to it. You can have a 605 credit score. You may not be qualified. These are the minimum requirements. It doesn't guarantee you a loan. Same thing with conventional, same thing with VA, same thing with USDA. Doesn't guarantee you a loan. There's a lot more to it, but those are the minimum requirements that we're striving for. All right, so assets. This is money that you have saved up that you're using towards the down payment and closing costs. This can come from your money that you saved up. This can come from a gift. Mom, dad, aunt, uncle, cousins, sister, brother can all give you a gift. Depending on the loan program, it's very finicky with cousins. Let's have a conversation on what qualifies as a cousin first, okay? All right. Retirement account. This money can come from retirements. You can even get a gift from a church or your synagogue. All right, so this is what we're looking for. Income versus debt. I went over that. Debt is what is reported in your credit report and includes but not limited to child support obligation and taxes owed. If you owe child support, that is part of your debt to income ratio. If you receive child support, you can use that as income. That child support that you receive has to have a 3-year continuance. So if that child is 16 years old, we can't use it. If you're getting it less than 3 years, we cannot use it as income. IRS for our self-employed people, or even if you're not self-employed. If you owe money to the IRS and are on a payment plan, I got to add that to your debt to income ratio. Okay. Let's talk about student loans. That's the big thing. We always talk about most people have it. Hey, there's nothing we can do about it. Most people are in forbearance. The word forbearance doesn't exist in my world. In the mortgage world, the word forbearance is not a real word. There has to be a payment associated with the forbearance because eventually there will be a payment with that student loan. Each loan program is different. Look, for FHA, we're going to use 50 cents on the dollar. On Fannie Mae, we're going to use dollar for dollar, and Freddie, we're going to use 50 cents. What does that mean? If you owe $100,000 in student loans and you're doing an FHA loan, that's 50 cents on the dollar. I got to hit you at $500 a month as your obligation. There has to be a payment in your debt to income ratio. Okay. So we're going to factor in whatever your forbearance is, and then we're going to make a payment for you. Now, some people are on income payments. It's called IDR, income driven repayments, saying, listen, I have got $100,000, but based off my income, I only owe $90 a month. Yes, we can use that. If a buyer provides a letter saying that your payment is income based and it's only $90 on your $100,000, I can do that. That's much better than hitting you at $500 a month. That's sometimes the difference between qualifying or not. Jennifer, I'm looking at student loan payment that must be associated, meaning what the payment would be, or if it wasn't, or I should pay them. All right. So if you're in forbearance, I'm not telling you to go start paying. Okay. I'm telling you, if you're in forbearance, we have to have a payment associated with it in order for you to qualify. Whatever your forbearance is, I'm going to take 50 cents on the dollar or dollar for dollar, depending on your loan program. If you have an income driven repayment schedule, I can use what's on there. Okay. All right. Glad that makes sense. All right. How is your payment broken down? Anytime I give someone a payment, my buyers out there, I'm always going to give you what your taxes and insurance on estimate would be. I'm going to break down the entire thing. I'm never going to tell you, hey, your payment's $1,300 plus taxes and insurance, so you figure that out. I'm always going to give you all in what is PITI, which is payments, principal, interest, taxes, insurance, what your estimated payment would be. So let's talk about what the payment broken down is, when your payment is due, and what an escrow account is. Okay, so PITI, exactly what I said. Principal, interest, taxes, and insurance. Okay. When is your payment due? Okay. Sometimes when you're renting a house or an apartment, it's due on the day you move in. So if you rent on the 15th, it's due on the 15th. You rent on the 7th, it's due on the 7th. Mortgage is not like that. I don't care what day of the month you close. You can close on the 7th of the month, 10th of the month, 15th of the month. It doesn't matter. Mortgages are always due on the 1st. Always. I don't care what lender you use. Always due on the 1st. And it is always late after the 15th, which means in the mortgage world, we give you a 15-day grace period to make the payment. Now, I'm not telling you to make your payment on the 12th or the 13th, but if you do, there's no harm, no foul. I'd like you to make your payment on the 1st. It's easier. Once you get into that rhythm, less mistakes are made. After the 15th, it's late, you will get a late penalty. After the 30th, it gets reported to the credit bureaus as a late payment, 30-day payment, 30-day late, which will affect your credit score for a long time. So let's try not to get into that habit. Make your payments on the 1st, but it's not late till the 15th. How is your payment broken down? In this scenario, we're using a principal and interest, homeowners insurance, property taxes, and the mortgage insurance. In this case, that full PITI is $24.24. That means when I'm quoting you a payment, your payment in this case would be $24.24. How is this broken down? Just like it says, every single time you make a payment, the lender receives that $24.24. We take $18.96 and we put it to your principal and interest. That homeowner's insurance in this case is $100 a month. Whatever your insurance premium is an annual cost. In this case, it's $1,200. We break your annual cost down to $100 a month. So you make that payment. Every single time you make that payment, we take the $100 and put it to the side for you. Same thing with your taxes. We take your tax bill, which the county or the city, depending on where you're located, we get that bill, we break it down to a monthly number. We include this in your payment. In this case, it's $250 a month. So the taxes is the same concept. The tax bill is not due until the end of the year. Same thing with your insurance, only once a year. We collect it monthly. Whatever the city tax is, whatever the county tax is, we break it down to the monthly obligation. We add it to your payment. Okay. Mortgage insurance, whatever the mortgage insurance factor is, we add it to your payment. Like I said, the 1896 goes towards the loan. The homeowner's insurance and taxes goes into your escrow account. The mortgage insurance gets paid directly monthly to the mortgage insurance company. When the property tax bill is due, when the insurance bill is due, we as the lender pay it on your behalf from your escrow account. That is what an escrow account is. It is set up by your lender to manage your taxes and insurance. You, as a buyer, never have to make that payment by yourself. You pay it monthly. In other words, it's like layaway. You want that item for Christmas at Target or Walmart? You pay it monthly. Your taxes and insurance is paid monthly by you. We, as the lender, will pay you when it's due. Does that make sense? Is any questions on how an escrow account is set up and what the definition of it is? My buyers out there, anyone? Good. At any time, if you close the loan, that means you sold the loan. That means you closed that loan to refinance. Hey, if you win the lotto, which is 410 million this week, if you hit that and paid it off, you close the loan. Whatever is in that escrow account comes back to you. That is your money. All right, chapter 2, pre-qual versus pre-approval. I love this part. We're going to talk a little bit about a contract and what the earnest money is. What is the difference between a pre-approval and pre-qualification? When I run your credit, I take your loan application. That is a pre-qualification. It's just your basic financial stuff, your information that you provide, okay? A pre-approval is when I collect your assets, when I look at your income, when I go over everything. I validate your financials. I review your credit report, compare it to your financials, and make sure that everything is in a line with the loan program. I cross T's, I dot I's. We validate you as a homeowner, as a buyer. That is the difference between pre-qualifications and pre-approvals. If you are a buyer on this call, if you are a real estate agent on this call, and you get a pre-qualification letter from a lender, your first question is, have you validated this information? Because I don't want a pre-qual, I want a pre-approval. There is a difference, okay? We at Stockton Mortgage, half of my team is on this call. There's nobody on this call that is going to give you a pre-approval without running basic underwriting findings. That's part of the pre-approval process. We are going to cross every T and dot every I. So you as a buyer, you as a real estate agent, will go home looking for homes with confidence. That is the biggest difference in this market. We need our buyers to be shopping with confidence. We need our agents making offers with confidence that if your offer and when your offer gets approved, that you know that the financing is buttoned up. Okay, there's a lot of lenders out there that don't button that top button. We button every button on the shirt, okay? So we validate. That is the most important piece of this slide, is that word validation. All right, what is a contract? It is just a binding agreement between buyer and seller. We got some really good agents on this call that are professional and know how to negotiate the contract correctly. So I appreciate you guys. Thank you. It is a contract and is negotiated by the agent. Once all parties agree to all terms in that contract, we have a binding agreement. If we're back and forth, no binding. The moment all parties agree is when we're binding. So what is negotiable in the contract? All right, everything with a number. If it has a number in it, it's negotiable. Close date, sales price, seller's contributions, due diligence, financing, appraisal contingencies. Close date has a number. It's all negotiable. Your attorney is going to be picked for you by the agents. That is also negotiable. If your mom or dad or somebody in your family, your best friend, is a real estate attorney and you want to use them, please let your agent know, because they're going to request that. Otherwise, these agents, they know who the best attorneys are. They're going to, on your behalf, pick one for you. Okay, all of these details are negotiable. All right. Does anybody not know, my buyers, what a due diligence period is, what an appraisal contingency is, what a financing contingency is? Anybody not know what that is? All right. If anyone needs to dive in deeper on what those are, let me know and I will explain that. Every one of my buyers has a Mortgage 101 class that I provide. If you're, and we're on that class, we dive into how that protects your earnest money, what the earnest money is, and those periods and how it affects that. So let me know. I can dive in deeper on the next time. Okay, great. Due diligence period is an opportunity for the buyer to do their inspection. You're doing your due diligence on the property. It's negotiable. Normally, they're about 2 or 3 days. The busier the market gets, the shorter that period is because we've got to make our offer as strong as possible. So if you're an agent, you should have 2, 3, 4 inspectors in your Rolodex to get these out as fast as possible. In this conversation, let's say it's 3 days. Now, the earnest money is tied to these days. The earnest money is a check that a buyer provides, negotiable in a contract. Let's say the sales price is $250,000. It's normally 1%. Again, negotiable. So in this case, it's a $2,500 check that the buyer gives to the real estate agent. And that real estate agent says, hey, I got a $2,500 earnest money check. The buyer has already spoke to the financing company, which is Dave, and we're confident about the financing. We're going to buy your house and we're going to adhere to all the details in the contract. Here's your $2,500 earnest money check. Please don't show this house to anybody else. I'm buying it. Great. Awesome. We get our due diligence done. Okay. Let's say there's an issue in the inspection period. As long as you're within your due diligence period, you can renegotiate the terms of the contract. If you cannot renegotiate the terms, you can walk away and get your earnest money back. In this conversation, let's say it's 3 days. Let's say on day 4, you said, hey, I got my inspection done. Got a problem with the roof. I got a problem with the foundation. I'm walking away. Essentially, you're out of contract. That seller does not have to give that earnest money back. They do not have to renegotiate terms. That is why it is important for me as a lender and every single agent on this call, and I know I work with most of you and you're really good at it, they follow those dates specifically. They protect the buyer. That is why when someone comes to me and says, should I do a FSBO? I said, absolutely not. I want to buy this house on my own. I don't need an agent. No. These agents, all the good ones, they're following these dates. They know how to protect your money. It's the largest transaction you'll ever make in your entire life as a buyer. You need representation as an agent and as a loan officer to make sure that your money is protected. That is why it's important to have a realtor on your side. Okay, due diligence gives you an opportunity to do an inspection to make sure that there's no issues with the house and gives you an opportunity to renegotiate terms based on the inspection. Your financing contingency, it's normally about 7 to 10 days. Sometimes it's 0. I can remove financing contingencies on certain buyers, makes your buyer stronger. But if there's a reason for me to deny you from a financing reason, I have to do it within the contingency set forth in the contract. The appraisal contingency. We're going to send an appraiser out there to make sure that the value meets the sales price. If it doesn't, it needs to be within the date set forth in the contract. If it doesn't, then your earnest money is not protected. Okay. Let's say we're buying a $250,000 house and the value comes in at $245,000. If we're within our appraisal contingency, we have an opportunity to renegotiate terms. If you can't renegotiate terms, you walk away and get your money back. Same token, let's say that appraisal comes in at $255,000. That seller doesn't know. And even if he or she does, we cannot renegotiate terms. It's set at that $250,000. We can only renegotiate if it goes lower. Okay? Does that make sense, guys? Did that answer your calls, what that means? All right, moving on. So what's new? We throw out these new terms on these new niche products, the 2-1 buy down. By the way, it's not new. It's been here for a long time. We just never needed it. So what is the 2-1 buy down? How does it benefit a seller? How does it benefit a buyer? It makes the transaction or the loan more affordable for a buyer. The 2-1 buy down means, let's say we're qualifying a buyer at 7% and we have a 2-1 buy down. You have a 2% interest reduction for year 1 and a 1% interest reduction in year 2. 2-1 buy down. 2% the first year, 1% the second. If we're qualifying them at 7%, year 1 will be 5%, year 2 will be 6%. Then on year 3 through a 30-year term, or whatever term the loan is being written at, it goes back to that normal 7%. In this case, that's what our scenario is. What does that mean in real terms? Let's just say the payment at 7% is $2,000. And on year 1, a 2% reduction is $1,800. That's a $200 a month savings per month. That is $2,400 a year. The second scenario, the second year, you're saving $100. That is a $1,200 reduction in the year. So it costs $3,600 to do this 2-1 buy down. The seller pays that. Instead of the seller giving you seller paid closing costs, they say, hey, I'm going to give you $3,600 so you can afford this house, and we're going to buy that 2-1 buy down. It helps the buyer for a 2-year period, and it makes the seller makes their home easier to sell, and it initiates more buyers. It gets more buyers in the door saying, I will buy your 2-1 buy down for you. That is what a 2-1 buy down is. What makes this program so great? The buyer has access to a 2-year reprieve. If the rates drop from now until before that 2-year period is over, which everyone thinks they will, they refinance. That's the buyer's money. It's in an escrow account. They get it back. It doesn't go back to that seller. It goes back to the buyer. And they can use that for their refinance. Okay? Hopefully the rates come in and you refinance into a term that is now back in the 5s for the next 30 years. So for the first year, you get a 5% rate. The second, you get a 6. We're hoping we refinance into a permanent 5 and change loan. That's how the 2-1 buy down works and why we would use it. Can the buyer, who's an investor, buy this 2-1 buy down or similar buy down themselves on a purchase or refi? Okay, let me read that again. Can the buyer, who's an investor, so we're using an investment property? Is that what we're asking? It probably won't work for an investment property because the maximum amount of seller contributions is 2%. The seller has to pay for this. The buyer can't pay it. Okay? I'm not going to tell you it's going to work when the caveat says it can't. So it's not going to work for investors by themselves on a purchase or refi. On a refi, we're never going to do a 2-1 buy down because there's no seller. It's only for purchases. Can the buyer buy? Yes, the buyer can still buy down points. So when you're buying down points, that's a permanent buy down. The 2-1 is a temporary buy down, right? It's only for the first 2 years. When you're buying down points, that is called a permanent buy down. People ask us all the time, hey, can I just buy down points? Sure, but you're not going to buy down an entire point. It's expensive. Rates go in eighths, 1/8 increments. So if a permanent buy down starts at 7, we're looking at the next rate is 6.875, then to 6.75, and so on. We'd have to see what the cost would be to buy that rate down in 1/8 increments, compare it to the cost to see if it makes sense. That is a permanent buy down. And the buyer can do that, yes. Where the temporary, it's a whole point. Great question. Yeah, the seller funded buy down is just a creative financing option to generate more opportunities. That's how it benefits the seller. We went over what the earnest money check is. It's a good faith deposit. We know what these dates are. Can closing costs be rolled into the loan? No, you cannot. Remember what I told about USDA? It can, but we need the value there. Okay. So how can we get creative and roll in closing costs? You can increase the sales price on a FHA loan, conventional loan, VA loan, and then the seller give back seller paid closing costs. We can do that, but it's not rolling it in, you're financing it. Again, we still need value, but we'd have to increase the sales price. So if The value of the house, let's say we have a $250,000 house. The sales price is $250,000. The value comes in at $255,000. Can we roll in the closing cost? No, because the sales price is still $250,000. The only way to roll those closing costs is if we increase the sales price. That's how we do it. Yep, we went over that. Okay. Seller paid closing cost. Can the seller pay your closing cost? Yes, it's negotiated in a contract. Every loan program has a different amount of what they can or cannot contribute. How much does the buyer need as a buyer? How much do you need at closing? Where do we get this number from? We have your down payment. We got your escrows you're required to initiate. You got your closing costs. We add those all up. We deduct your earnest money that we talked about earlier. We deduct any seller paid closing costs. And that is where we come up with what is called cash to close. That is required a day or the day of at closing. You will wire those funds to the attorney, 24 to 48 hours. All right. Day of closing, bring your ID, sign your paperwork, get the keys and celebrate. That's it. All right. That's it, guys. Do we have any follow-up questions that I didn't go over? All right, we got it. 59 minutes. I said an hour. Oh, we got Jen. All right. I'm interested in much more about how much home equity, at least 80,000, can count. Part of the down payment. You're buying the house you've been renting for 10 years at a lower price than it's worth since my mom owns it. It will be my primary residence. Okay. All right. So if your mom owns a house that she's selling to you, can you use the equity in the house for a down payment? That is a great question. Yes. We can do what is called a gift of equity. You can only do that from a family member. You can't buy the house from the Smiths and use that equity as a gift of equity. So you're buying the house from your mom or a family member. Your mom can give you a gift of equity for the down payment. Okay. Does it affect the interest rate? Not really. Interest rate is driven from your credit score, loan program. Can it factor into your interest rate? Yes, because you might have a larger down payment. You're in a different loan program with a higher 20% down payment versus 10. Yeah, so it could affect the loan a little differently. It can essentially affect your interest rate. Yeah, we'll sidebar that because I want to know more about your interest, your credit score, and I'll let you know the difference. But yes, you can definitely use that home equity as part of your down payment for that gift of equity. Sure. Great question. Looks like Marquise is typing. I get it. Having it being part of the down payment is great though. Okay. All right. Any other questions? If you're interested in a follow-up and we could dive deeper into any one of these slides, let me know. I can schedule that. We do mortgage 101s. That's diving a little deeper into what we talked about on an individual level from that specific buyer's criteria. Amber's going to send everybody tomorrow a copy of this slideshow and a copy of the recording. That's it. I appreciate you joining us for this 1 hour of your day. I hope you guys learned something. If you need us for pre-approvals, we're here. If you want questions as a buyer, let me know. We'll schedule something. Oh, great. My pleasure, Jennifer. All right, guys. Hope you have a great day. Talk to you soon.